What is the best decision is how you are investing the funds. What kind of funds you are investing in the purchase of fixed assets. Equity capital means the money collected from the equity shareholders and the money collected from the debenture holders. They will be considered as borrowed funds. The entire profit will not be distributed to the shareholders. A part of the profit will be retained in the business and the part of the profit will be distributed to the shareholders. Hello everyone, I'm Purnima, faculty in the Department of Commerce and Management, Vidhyaashram Pre-University College, Temple of Excellence, Mysuru. I welcome you all to this session. In this revision session on Chapter 9, that is Financial Management, we will be discussing these various topics. See, that is meaning of business finance, financial management, objectives, financing decisions, investment decisions, factors affecting capital budgeting, factors affecting financing decision, dividend decision, factors affecting dividend decision, and also what is financial planning, importance, capital structure, factors affecting capital structure, fixed and working capital, management of fixed capital, factors affecting fixed capital, working capital, factors affecting working capital. So these are the various topics we will be discussing in this chapter, but from the examination point of view, I would like to tell you that the factors affecting fixed capital, factors affecting working capital, and also the importance of financial planning, factors affecting the investment decision, these are the most important ones. And then next one will be the objectives of financial management. So you can expect 1 mark questions, 2 mark questions, and 4 mark questions from these chapter, and also you may expect 8 marks question from this chapter. So please make a note of it. From the examination point of view, this chapter is quite important but quite a tough chapter, but if you can understand it, then it will be very easy for you. Now let us understand what is the meaning of business finance. So business finance is the money required to run a business. So whatever money you are using to run a business, that is called as business finance. Almost all business activities require some finance. It is needed to establish a business, to run it, to modernize it, to expand it, and to diversify it. So any business which we will be having the usage for money. So for a business, to establish a business, we need money. To run it, to modernize it, to expand it, everything we need money. Then the next one is financial management. It is concerned with optimal procurement as well as the usage of finance. So financial management is you get the best source of the finance and the best usage of finance. That is financial management. For optimum procurement, different available sources of finance are identified and compared in terms of the cost and associated risk. So when you are identifying the different sources of finance, you have to compare them with the different costs and also the risk associated with each source. Then let us understand what are the objectives of financial management. So they are some of the examples of financial management decisions. Now, what are the important financial management decisions? The size and the composition of the fixed assets of the business. So, what is the size of the business and the composition of fixed assets? Then, the quantum of current assets, its breakup into cash, inventory, and receivables. Then, the next decision involves the amount of long-term and short-term funds to be used. Then next one will be breakup of long-term financing into debt and equity. Then all items in the profit and loss account, that is interest, expense, depreciation, etc. So these are the various decisions involved in financial management. Next, The objectives of financial management. The primary aim of financial management is to maximize the shareholders' wealth, which is referred to as the wealth maximization concept. Now, the main objective of financial management is to ensure that there is maximum utilization of wealth. The market price of a company's share is linked to the three basic financial decisions, that is the investment decision, financing decision, and the dividend decision. So based on this, the market price of the shares will be fixed. Then let us understand what do we mean by the investment decision. A firm's resources are scarce in comparison to the uses to which then they can be put. A firm has to choose where to invest these resources so they are able to earn the highest possible return for the investors. The investment decision therefore relates to how the firm's funds are invested in different assets. Now, in the investment decision, we have to make the best decision. So, what is the best decision is how you are investing the funds. What kind of funds you are investing in the purchase of fixed assets. So, that becomes an important investment decision. Then, the next one is this investment decision can be also called as the capital budgeting decision. So there are certain factors which affect the capital budgeting decision. The first one is the cash flows of the project. When a company takes an investment decision involving huge amount, it expects to generate some cash flows over a period. So the first major factor to be considered while capital budgeting is the cash flows of the project. Second one is the rate of return. The most important criterion is the rate of return of the project. So these calculations are based on the expected returns from each proposal and the assessment of the risk involved. So, what is the return from each of the proposal and what is the return you are getting? Then, third one, the investment criteria involves the decision to invest in a particular project involves a number of calculations regarding the amount of investment, interest rate, cash flows, and rate of return. So, the investment decision involves decision relating to what is the amount of investment you are doing, what is the rate of interest you are paying, what is the cash flow, and the rate of return. So, there are different techniques to evaluate investment proposals which are known as the capital budgeting techniques. So, in order to evaluate these decisions, we have the various capital budgeting decisions to help us in the investment decision. Next, we have the financing decision. It involves identification of the various available sources. The main sources of funds for a firm are the shareholders' funds and the borrowed funds. Now, we know that any share capital comprises of two types of funds. One is the shareholders' fund, other one is the borrowed fund. So, with the help of these, we will be able to collect the share capital. Now, in these two sources, which is the best source we have to decide, and also the ratio of the source from which we are collecting the funds. The shareholders' funds refer to the equity capital and the retained earnings. Borrowed funds refer to the finance raised through debentures or other forms of debt. So, equity capital means the money collected from the equity shareholders and the money collected from the debenture holders. They will be considered as borrowed funds. Then, what are the factors affecting the financing decision? In this, the first one is the cost of funds. Now, what is the interest you are paying in order to raise the fund? That becomes the cost of the finance. Second one is the risk involved. So, risk involved refers to what is the collateral you are giving, or what is the risk of losing any of your asset in case you are a defaulter to repay. So that we have to calculate. Third one is the flotation cost. So it refers to the cost of issue of equity shares, cost of issue of the preference shares, or cost of issue of the debentures. Then the cash flow position of the company, whether the company has a continuous flow of cash throughout the year. So if there is a continuous flow of cash within the company, it is best for the company to go in for a debt financing. Then fixed operating cost. So if the company has fixed operating cost like the rent, salaries, etc., then they have to think about what is the return on this kind of a investment, and then they decide what is the financing decision. Then control considerations. So in case the company decides to raise finance by the issue of equity shares, then it will result in dilution of the control of the company. So if the company is ready for dilution of the control, then it is best for them not to go in for equity shares. Then the next one is the state of the capital market. So if the share market is favorable for a fresh issue of equity shares, then it will be better for the company to go in for a new issue. But if the stock market is not so very responsive, then the company may not go in for a fresh issue of shares. Next, we have the dividend decision here. The dividend is that portion of profit which is distributed to the shareholders. The decision involved here is how much of the profit earned by the company is to be distributed to the shareholders and how much of it should be retained in the business. Now, in the dividend decision, we should understand that it is the part of the profit which will be distributed to the shareholders. Now, the entire profit will not be distributed to the shareholders. A part of the profit will be retained in the business and the part of the profit will be distributed to the shareholders. Now, in this dividend decision, we have to decide what part of the profit should be retained in the business and what part of the profit should be distributed among the shareholders. Then, so while the dividend constitutes the current income and reinvestment as retained earnings increases the firm's future earning capacity, the extent of the retained earning also influences the financing decision of the firm. Now, whatever part of the profit you have kept it as retained earnings, so that will be affecting the financing decision. So if you are having more retained earnings, then you need not go in for any new source of income because you will be already having the reserves of cash within the company itself. Then, what are the factors affecting the dividend decision? The first one is the amount of earnings. What is the volume of profit the company has earned in the previous year? If it is a very huge profit, then the company may keep a part of it as retained earnings and distribute the next part as dividend to the shareholders. Then second one is stability of earnings. So if the company has stable profits over the so many years, then the dividend decision will be you have to pay them the shareholders the dividend just like the last year itself. So there will not be any change in the dividend decision. Then third one is stability of dividend. So if the company has a history of paying dividend year after year, then it has to maintain that same procedure year after year. So you cannot deny any dividend to the shareholders. The next one is the growth opportunity. If the company has lot of growth opportunities before it, then it is best for the company to retain a part of the earnings as retained earnings. Then the next one is the cash flow position. So depending on the cash flow position of the company, we can decide whether the company wants to go in for a dividend decision, what kind of a dividend decision it wants. So if there is lot of retained earnings in the company and the cash flow is also good, then the company may resort to 100% dividend distribution. Then the last one is the shareholders' preference. So depending on the shareholders' preference also, the company can decide whether to pay dividend or not. Then the next one is the taxation policy. So what is the taxation policy? So if the tax to be paid is very high, then the company may just resort to dividend decision, may resort for a lower payout ratio in dividend decision. Then next one is the stock market reaction. So if the stock market is favorable, then the company may expect to declare dividend to the shareholders. Then access to capital market. So if the company is in a position to access the capital market easily, then the dividend decision will be favorable. Then legal constraints. So whatever the legal regular rules and regulations, they have to be followed by each of the company under the Companies Act of 1956. Then contractual constraints. It refers to certain contracts which the company has entered into between the borrowers and the company. So these are the factors affecting the dividend decision. The next, let us understand what do we mean by financial planning. It is essentially the preparation of a financial blueprint of an organization's future operations. So what is the future operation of the organization and what is the plan you have for the future operations? The objective is to ensure that enough funds are available at the right time. So whenever the company is in need of funds, the main aim of financial planning is to ensure that the company has funds at the right time. So it aims at choosing the best investment and financing alternatives by focusing on the cost and benefits. So by focusing on the cost and benefits, so we can just decide the aim of financial management. Then what is financial planning? It strives to achieve the twin objectives. So what are the twin objectives of financial planning? To ensure availability of funds whenever required. So we have to ensure the availability of funds whenever is required, to see that the firm does not raise resources unnecessarily. So we should also ensure that the firm does not raise the resources unnecessarily. Next, let us understand the importance of financial planning. It helps in forecasting what may happen in the future under different business situations. So, and what are the different business situations and what events may take place? All this will be there in financial planning. Then it helps in avoiding shocks and surprises and helps in preparing for the future. So when they think about the future, with the help of financial planning, we will be able to cope up with any situation which may arise. Then it helps in coordinating various business functions, that is sales and production functions, by providing clear policies and procedures. So with the help of financial planning, we will be able to coordinate the functions of different departments. Then the next one is detailed plans of action prepared under financial planning reduce the waste, duplication of efforts and gaps in planning. So with the help of financial planning, we will be able to reduce the waste, then duplication of efforts and also the gaps in planning, and it tries to link the present with the future. So these are the importance of financial planning. Please make a note of it. It's very important from the examination point of view. Then next one is it provides a link between investment and financing decision on a continuous basis. So with the help of financial planning, it is a link between investment and financing decision. Then by spelling out detailed objectives for various business segments, it makes the evaluation of actual performance easier. So with the help of financial planning, we will be able to just evaluate what is the actual performance of the business. So with this, we come to the end of this session. Hope you have all followed it. Thank you.